Hello, everybody. This is Jake Stenziano, host of the Wheelbarrow Profits Podcast, here with my co-host, the multifamily mentor, the coach, the chef, the father of six, the best-selling author, the G-Daddy, Gino Barbaro. Gino, how's it going?
Mr. Stenziano, doing good. How you doing, bro?
Always making it happen, big man. Today's guest is Mike Conlon. Mike is a real estate investor based out of Cary, North Carolina. He received a law degree from the University of Minnesota in 1990, but has made real estate investing his main focus. So without further ado, Mike, welcome to the show.
Hey, guys. Thanks for having me.
It's our pleasure. Why don't you just get this thing kicked off and tell us about your jump going from law into real estate and why you made the move and the story there.
Yeah, it's sort of a crazy story because I really didn't know anything about real estate when I jumped in. I got my law degree, went right into banking. Then I did a stint for about 10 years in financial planning, owned a broker-dealer, which was a weird thing, ended up selling to a large insurance company. So it worked out well. But when the thing that changed my life really was Rich Dad, Poor Dad. I read that book. I learned about depreciation, passive income. I loved the financial planning business. I was making good money, but I was working 60, 70 hours a week. It was a grind. You know, we went through some of those downturns in the early 2000s, and I'm like, I got to get out of this thing. I can't deal with all these people. And so once I read that book, I'm like, this sounds like a great idea, except I had no experience. The only experience I had in real estate is I sold 2 houses and lost money in both.
Why real estate?
You know, I really like the passive income. Obviously, I think that's everybody's dream, is to be able to make money while you sleep. So that really attracted me. And also the depreciation, which, you know, is the greatest tax deferral strategy available right now. And I think people underestimate that. And when you're in a normal corporate environment, you're getting that W-2 and you're getting whacked with taxes, and you get that tax deferral when you switch over to real estate, it's night and day, and it makes a big difference.
We're gonna hammer college, me and you, later. We're gonna go and destroy college. I'm gonna keep that for later.
Sure.
But I find it to be amazing that a guy who's got a law degree and who has a financial planning business knows nothing about depreciation and real estate benefits. Isn't that amazing? Don't you find that to be truly mind-boggling?
It was crazy. I'd never been exposed to it. I didn't really know anybody. I grew up in Wisconsin, so, you know, the commercial real estate business wasn't big by any means. And, you know, I knew a couple people that owned apartments. I had no idea what a mobile home park was really until 2005. I had no concept, but you never taught that in high school, college, nothing. You don't get exposed to it. Obviously, that was pre-internet too, you know, when we were growing up, so it was a little bit different. You didn't have access to the information you have now.
So let's dive into your investment strategy.
Sure. So, you know, basically when I started in 2002, I just bought a couple properties in Wisconsin because I figured I got to get in the game. I'm not really sure what I'm doing. And that's the one thing I tell, beginning investors is you got to do your research, you got to do your analysis, but you really got to take action at some point. You got to jump into the game. I jumped into the game, had no idea what I was doing, really didn't make any money in the first couple deals. And then what I realized is that multifamily or mobile home park investing, I'd sort of look at them in both ways, is it's all about jobs, and jobs are about big cities. So in early 2003, I decided to move to Orlando from Wisconsin. Obviously, for the weather was a lot better. But Orlando was booming at that point in time, and we decided to buy multifamily properties, which you guys are, I know, actively involved in. And so we had, over a couple years, we accumulated 8 properties between 64 and 120 spaces.
Wow, that's great. How do you find deals in the mobile home park niche?
Well, in the park niche, for me right now, it's all about brokers. I know everybody. I've been in the business long enough now to know it. And I would encourage beginning investors, if they get started, is take that broker out to lunch, whoever it may be in your area, get to know them as well as possible. You know, the other thing I think for beginning investors too is to get that junior broker involved. Because there's always a senior broker and a junior broker, and the junior broker is hungry like you are. They want to get some smaller deals done. The bigger broker won't pay attention to you to become a bigger fish. So that's number one for me is brokers. Number 2 is really mailing lists. I mean, I know a couple guys in Charlotte that have started in the last year doing mobile home parks, and they've done a great job of getting the list together, doing the quarterly mailings to all the owners. It's a lot of work, and it's not fun. It's tedious. But it does pay off because in the mobile home park business, there's still a bunch of mom and pop investors. Unlike multifamily, which has gotten a little more institutional, mobile home parks are still guys mom and pops who bought it 30 years ago and now are looking at selling the parks.
So what's your investing criteria for a mobile home? Lot rental, cash flow, cap rates? What are you looking for in these deals?
I'm a lot rent guy. Most of the business was built on you rent the dirt. That's how you make the money. There
Mm-hmm.
are a few people in the business that run it like a horizontal apartment complex, and they want to own the units and rent them. I think that's a nightmare. I think that's a bad move. So of the say 4,000 spaces we have less than 10% of the homes that we own. I'd prefer to own zero, to be honest with you, but it's just a function of the business. You own some of them, especially the new homes. So basically, what I'm looking for is initially it was a couple years ago, especially in 2012, when we started actively buying portfolios of mobile home parks. You're looking for that 10 cap with upside. That obviously doesn't exist anymore. I'm buying now 7 caps, but they have to have anywhere from $50 to $100 of upside within the first 18 months and market rent. And the difference in mobile home parks versus multifamily is that everybody's on a month-to-month lease. So you send out one letter, everybody's rent goes up at the same time. So let me give you an example. I bought a park in Raleigh.
I didn't know that.
It's a lot easier. Unlike multifamily where, it's a big difference where you have to wait for the leases to renew and all that stuff. People in mobile home parks have been there a long time. Yeah. So it's a different scenario, but I bought a park in Raleigh in 2015, 200 spaces. We paid a 7 cap for it. And I was a little nervous on the 7 cap, but the rents were $255, and I know Raleigh's a $395 market. Now we just have bumped in just under 2 years. We bumped it up $100. So they're at $350. $350 times 200 units, $100. That's $20,000 a month. Yeah. So that's been a great deal for us.
What's the strategy when you buy a park, but you also acquire the homes with it? What do you do in those scenarios?
I typically, and I have a great chief operations officer. That's another thing. Once you get big enough, you need to have a really good operations guy. But we go around to the residents, especially on the older homes, anything 2005 or less, and we'll sell them for $2,500. I don't want to own the homes. In the mobile home park business, it's all about high lot rents, and that's where you can finance stuff. That's where people buy it off of. The homes typically are a depreciating asset that theoretically that home payment should go away over a period of time. And so I don't value the homes at all. I give them away or $2,500, and I try to get the lot rent at $350, $395.
Mike, what happens when you raise the rents and they don't pay? It's on month to month. All of a sudden, because these guys are living month to month basically. So you go from $250 to $350. Can you give me this scenario? And they're like, Mike, I can't pay that. What happens?
Well, you got to understand, $350 is still compared to multifamily is cheaper. And in this park, it happens to have private utilities, which we can get into a discussion. So it has a well and a septic system. So they're not paying any utilities there either. So they're still well under the market. But, in Raleigh now, rents have gone up so much in the last couple of years. A reasonable apartment complex for a 2-bedroom is $800, and they're paying $350 for a 3-bedroom, about 1,000 square feet with nobody next to them on either side. And it's a good deal. Assuming that it's a quiet, calm park that, when you're the owner, you got to really run it tight like you guys do in your apartments. You just can't let any riffraff into those places.
So let's talk about the utilities and the expenses, because I know expenses run a lot less, right, between 30 35%. We're at the 50% clip. So let's talk about expenses and utilities as far as private and public utilities.
Yeah, well, the number one expense issue for us is we don't have any on-site or salaried maintenance people. So because we don't own many of the homes, we can do everything by contract. So that really helps. That was one of my big frustrations when I was in the multifamily business. We'd have a 100-unit property and we'd have 1 to 1.5 maintenance guys, and they'd quit and they weren't AC certified, and it just got to be a problem. So that's our number one savings right there, is we don't have to have that. And then as far as I would always recommend people, especially when they early on, is to get parks that have public utilities. It's just a lot easier. You can understand it. But don't be afraid of the private utilities. It took me a while to get comfortable with it and understand what it was. You have third parties signing off on it from a liability standpoint, so it's better. But our expense ratio, typical on a mobile home park, is about 40%. If you don't have the utility issue or you're not paying for any utilities, you can get it down to 32 to 35%. Which obviously that 10-15% is a big savings, on your gross income.
That is huge. Can you go back and tell us what your first mobile home park deal looked like and what you learned from it?
This is a classic deal. So my first mobile home park deal and again, I read something somewhere. We were in the multifamily business, and I read something that said, hey, parks are easier to manage. There's less maintenance, that type of stuff. I said, well, we got to jump in. We were in Florida at the time. And so we bought this 80-unit park in Lakeland, Florida, called Oak Hill Estates. The Estates was a misnomer. It was 80 spaces on 4 acres. It was so tight. I mean, basically people could reach out their window and touch their neighbor. It was so ridiculous. We had the 1 unit in front where it was so old that the lady had like the TV on and the hairdryer that the electric would blow out the whole time. So, I mean, it was one of those things, but it cash flowed every month. My chief operations guy loved it. He said it's way easier to manage than apartments. And so that sort of drove us to do it. When we left in 2006, we moved from Orlando to Raleigh because we had sold all our apartments in 2006. And we ended up selling the park as well, just because I was afraid of long distance management at the time. I'm not anymore, but I just didn't know. So we sold everything, and we only owned it about a year and made some decent money on it, and it cash flowed every month. So it was one of those positive first experiences, which is always nice.
That's the opposite of my first experience, that's for sure. But can you go into the demographics and what you look for in a market in mobile home? Because I know also they're not building them and they're tearing them down, so there's less inventory. So as far as finding them and what markets you're looking at investing in them.
Yeah, that's a great point, because there is no really competition. It's not like the multifamily business where they're going to build a brand new apartment complex, down the block or whatever. They really haven't built a new apartment complex in 20 years. And in that meantime, they've scraped a lot of them for malls and different mixed use developments. So really, I'm all about big cities. So we're Raleigh, Charlotte, Greensboro, Atlanta, Tampa. I'm in Madison, Wisconsin. I just bought a park in Pittsburgh. Any big metro area, you're typically within 20, 25 minutes of that metro area. The cool thing about the parks is they were built way out in the 70s and 80s, and now they're part of the suburbs. So they tend to be in pretty good locations for the most part. There's not a lot of inner city parks or rougher parks for the most part. So as long as there's a big metro area, I'm within 20, 25 minutes, I'm all over it. I tend to stay in the East Coast just because it's easier for me. I just don't like to, I don't need to travel a lot. So there's so much, for us, Virginia, South Carolina, those are 2 markets I'm just getting into, is Greenville and Columbia, which I like those markets too. So, we stay in the Southeast, a little bit in Midwest. There's plenty of opportunities and parks available. And there's still, I would say, another 5 years of mom and pops getting rid of their parks, because most of them were started in the 70s and 80s. And you want to buy from the mom and pops typically because they're not as sophisticated. They haven't kept up with the rents, that type of stuff. So that's where the real opportunity is in the business.
Can you talk about the property classes? Because I know in multifamily it's very easy. C properties, 30 years old, deferred maintenance. B, 20 to 10 to 20 years old. A, new stuff. So is it the same thing in mobile home parks?
It's a similar thing. It goes by a star classification. So it's usually 1 to 5 stars. The 4 and 5 star parks tend to be senior parks down in Florida, Arizona, wherever, California. Very nice, high end homes. There's that park in Malibu that, the houses trade for $1 million, $2 million and double wides. It's crazy, but a beautiful view, obviously. Those are the 4 and 5 star parks. Those cap rates are five now. They've been 5 for a couple of years. Those are institutionally owned and traded. All the big guys do that. Then you step down to where we go, which is really the C plus to B plus on the apartment side. It's the 2 to 3 star family park. That's where we are able to make the money. I'm typically looking for anything 100 spaces or more just to get some economies of scale. And really, basically what I'm doing is I'm trying to find those deals where there's a bunch of upside left. Like I said, I'd love to buy stuff at a 10 cap, but it's not realistic anymore. So I'm willing to go down to a 7 cap, but I got to be able to either raise rents a lot, fix up some vacant homes that are sitting there unrented, or add some new homes. We use the Clayton Cash program, which has been fantastic, and allows you to finance basically 70 to 80% of the home, so you don't have to come out with a whole lot of out-of-pocket expense. And if you add new homes, that's new revenue, obviously, So, and again, for me, it's all about the lot rent. So if I have multiple ways to do that, then I'm all over the park. But you got to be really careful right now because as we were talking about earlier, it's late in the cycle.
Is the financing different than multifamily?
It's tougher, especially when you get, say, sub 5 million in value, in loan value. If you go north of 5 million, you can go CMBS, which I do a lot of stuff with, which a lot of multifamily guys do. Fannie is real good on the 4 and 5 star stuff. Freddie's coming in a little bit, but not nearly as prevalent as the multifamily stuff. Once you get below 5 million, it gets tricky. And I've had a great relationship with a community bank for 15 years. That's really helped me get started. But the banks don't understand it. You really got to get a loan officer that's educated. They love the bricks and mortars of the apartment complex. They can touch it, feel it. In a mobile home park, they think the homes can move a lot. The homes rarely ever move. It costs $10,000 to move a house, and the people don't have the money to do it. So it rarely happens. And it's a lot better cash flow deal than the apartments typically. But the banks have been very hesitant to lend on it. So you really have to educate them on what the whole product is all about.
And that comes to your credibility. When you're first starting out, it might be difficult to convey that message. That's why Jake and I have that credibility book where you go into the banker and say, hey, listen, banker, look at the numbers. Don't look at the asset. Just look at what we're generating here. And that I guess, is impingent upon you and upon any investor to say, listen, this is our model here. We've been doing this. Look at our rest of our portfolio. We've been super successful. We're buying mom and pops in the 2 and 3 stars. This is what our product is, and this is what our potential is here. And I guess you have to sell it like Jake and I have to sell it, correct?
Absolutely. I mean, that's part of the game. You got to get in front of these guys, especially on the CMBS side. And again, now it's pretty frothy, so people come after us. They want our business. But on the community bank side, you have to go out and sell it. And one of the best things I did early on, and I didn't really know it, is I sort of sold to trade up. So I would, own a smaller property, say, when I first started, my first one was an 8 unit. I didn't know what I was doing. But even the mobile home park side, I had a couple 60 space properties that I bought as part of a portfolio. And it's nice to run those and then sell those after a couple years because it gives your investors credibility. They can get out of deals and turn deals. And it also gives the bank credibility that they're going to get paid back on deals. Mm-hmm. So if you're going to have a little longer term deal, they can understand that. But again, I sort of did that by just sort of happened. But I'd strongly encourage beginning investors to really think about holding a product for 2 or 3 years, selling it, getting your investors paid. Because once investors get that first check back, they really get a lot of confidence. And the first thing they're going to say is, where's the next deal? Because there's no way they're going to get the yield anyplace else.
Mm-hmm. How has your investment strategy changed over these last 5 years from a market that I know you're buying stuff for foreclosure, probably buying a 12 to 15 cap, and now you're buying at 7. So how have you had to adjust your strategy?
Here's just one small example of the portfolios we're buying back in 2011, 2012, early 2012. I bought 2 parks in Birmingham as part of a portfolio. Total cost for both parks, it's 190 spaces. Paid $850,000 for it, and just got it appraised for $4.2 million. So those were the days, obviously. And those don't happen a lot. And you feel fortunate to go through that cycle and have been able to capitalize on some of that. My hope is that, there is some type of downturn in the next couple of years, not significant, but at least it'll shake some of the froth out of the market in order to do that. Because, really when you're able to buy those distressed stuff, the deals are so easy, and I never thought that the cap rates would go down to, sub 7 on mobile home parks. But that's sort of where we're at now. So it's definitely been more cautious. Although last year we bought 9 properties and sold 9 properties. And what I did about a year ago, I sat down with a friend of mine, Matt Follett, who done very well in the business out in California. And he said, it's the time to trade away your so-called C properties, or in our case, the 2-star properties, and move up to the 3.5 to 4-star properties. And that's what we've done. Anything that wasn't quite a fit, that sort of had some private utilities, maybe wasn't as nice, we sold it because we got good prices for it, and we're able to buy stuff that was much nicer in better markets.
I was just about to say, Jake and I, we don't like to sell. So is that how you target your stuff to sell? Because we have an affinity with these things. They just start cash flowing. We buy them pretty good. We refi them out, and then we just get that continuous cash flow and that cost segregation going on. So is that how you target properties to sell?
Yeah, really, again, I bought a bunch of the the portfolios, so you ended up with some stuff that you didn't really want. Here's another example. One of the parks in one of the first deals we did, we bought from Bank of America, was 6 parks. One of the parks was complete junk. It was 60 spaces. There was 19 residents living there, had private utilities. You were a little nervous about it. I wanted the 5 other parks, but I'm like, I don't know if I even want this park. And it was just south of Greensboro. So it wasn't a bad location, but a little bit rural. I ended up throwing in an offer for $25,000. This is back in 2012. We bought the park for $25,000, 60 space park for $25,000, 19 residents. We got it up to 32 residents and sold it for $550,000. So it was a garbage park that I didn't really want, but I had to take it, and that allowed me to buy stuff better.
You just felt obligated. You just had to make that $500K. It was like, it was such a hard decision, but you got through it. I'm glad you're feeling okay about that one.
Yeah, it was very emotional for me, but it was
guys, is this like the point where we get the violin out, or what? Man,
you guys probably buy better than I do. You guys have been targeting. You guys were, if you didn't buy portfolios, you can more target what you want. Your strategy is a little bit more set. My strategy, just because I bought so many portfolios, I ended up with some stuff that was okay, cash flowed, but I also saw that there were better opportunities out there. So it was a little bit different situation.
So, Mike, when you bought these portfolios, were you bringing in investors? Were you going at all cash? Were you getting financing for them? How are you doing it? How are you taking it?
Again, I had a couple of my buddies to this day. I have about 10 of my buddies that do the deals. It's a little bit different than most people. I mean, most of the people in the business are money raisers in mobile home parks now. I mean, it was funny. We're at the national event in Chicago last year, and you got Apollo, private equity, you got Carlyle. Everybody's in a suit, a lot of ex-Goldman guys. I mean, 5 years ago it was all mom and pops and jeans and stuff like that. Now it's really changed because everyone's chasing yield. But initially I brought in a couple people, and I had this great relationship with a community bank that when I owned my broker dealer, they financed that, and we sold that and did really well with some of that stuff. So I had a track record with them. So I got them comfortable. They had financed some of my multifamily stuff, and that went well. So I convinced them on the parks, and that's what really went well. So I was able to buy some of these portfolios with their help, which really launched me, because otherwise you would have had to come in all cash because they were unfinanceable, basically, because they were in pretty good shape.
I want to jump into your book, Main Street Millionaire, Unconventional Wealth. I want you to tell the audience what an MSM is and how you came up with that idea. I love that acronym. It was awesome.
Well, I call it a Main Street Millionaire, and this was, I wrote the book, initially late 2012 and finally got it published in early 2015. But really what I saw what happened after 08, 09 is that, the world sort of came apart. But some of these businesses like mobile home park investing, or I got a really good buddy who kills it in used tires. I mean, I didn't even know there was a used tire business, and it's very big. But these Main Street guys who go after ugly businesses that do really well, and you would have no idea that they're multimillionaires. Salvage yards, and you can go on. Pawn shops, which have a sort of a bad stigma about it. The pawn shop's really a lending business, and I got a good buddy who runs the largest pawn shop in Raleigh, and they have a lending book over $1.5 million right now in loans, and the average loan's $110. Can you imagine that? I mean, how many people they're servicing? So it's
like
a business
20% rate, right?
That's 22% a month, but so they're making a little bit of money on that stuff. But it's just those things that, and I think it's all part of the book too. The big thing I talk about in the book is inequality. It's been around for years. In my opinion, it's only getting worse, which is great for mobile home park investing. It's great for you guys and the C and B properties, because the demand for affordable housing is through the roof. They're not making any more of it, and it's just going to continue. And our fastest growing segment, again, we have all family parks, but our fastest growing segment are seniors coming in. They have maybe $10,000 to buy a house, and they're living on Social Security. And there's so many of them. It's sad from a country standpoint, but it's reality.
I want to touch on that for a minute, because what we see in our market is we got these big guys, like the top 10, 20 owners of multifamily going in, buying C-class products, trying to put granite countertops in, trying to raise it up. But what they're finding, or at least what we're seeing, is that there's a demand for the C and B product. They're trying to push it to an A-type product in terms of price, And what they're doing is they're creating higher vacancy rates. Because there's new stuff coming on. Why not just go into the new stuff where they're trying to take this older stuff where they could just have it clean, safe, and affordable, fill it up, make a good yield on it, instead of they're trying to do this huge value add play that, I think is kind of disappearing in some parts. What are your thoughts on that?
Obviously, Orlando, they've done a ton of that value added stuff with the multifamily and tried to raise the rents and stuff like that. And I think it's the result of people having too much money to invest. Those big institutions have raised a lot of money. They're trying to invest it, and they can't get the A and B product anymore, so they're having to go down to the C and try to make that work. But I agree with you. As an investor, especially as a smaller investor, if you have a couple people that are working with you, why wouldn't you just keep it affordable? You don't have to do that much to really make it nice. And the number one thing people are is price. I mean, that's what they're looking for.
Yeah.
I don't, every market's a little bit different, but in Raleigh, if, in the apartment side of stuff, if you can get anything $800-900 now, that's safe and clean, they're all, that's full forever. So
and affordable to that point. So that's what I'm starting to see now is that just some of these guys are getting a little too cute with it and trying to turn something that doesn't need to be turned, where if they just maybe got the landscaping up a little bit, maybe did a little bit in the inside to make it look a little more desirable, they're overfixing is I guess what I'm getting at. And it's just I wanted to comment on one thing you said earlier. We are the flip side to what you're doing in the multifamily space, because we're looking for that small group of mom and pops out there that are still owning the multifamily, the C-class apartments, and that's exactly what we're targeting. So I just, hats off to your strategy, because that's essentially ours in the apartment space.
It's two things. I think number one, it's a sign of the times of where we are in the cycle. When you see big players going down to the C properties, we're late in the cycle. There's no question about it. But I think also that from that mom and pop standpoint, it's just a lot easier to buy from them. When I'm trying to buy other parks from other guys like myself, they all want the highest price, and
that's why you're buying 7 caps.
Yeah,
I'd like to sell at a 7 cap too. I looked at a deal this morning, and I'm thinking to myself, I didn't say it to the broker, but I was thinking to myself, if I was in these guys' shoes, I'd be doing the same thing. Therefore, I don't want it. I didn't say it to him. I said something to the effect, the siding looks durable or something. I don't know what the hell it was. It's a crazy time, and it's I think.
If you look at all the legendary real estate guys, like in New York, it's what the LaFrac family and stuff like that, they never sell, ever sell. And I think you guys are doing the right thing. If you buy it right, you never sell. There's parks that I have now that I'll never sell. I'll give it to my kids. That's where you create incredible wealth in families with, passing on with stepped up basis and 1031s and all the other stuff that you can do. So I think that's an amazing thing. It just, I think the hardest part for anybody is your first deal. You just got to get into the game. And I give you guys a lot of credit for spreading the word, and you're really helping a lot of people, because it's difficult. That's the hardest thing I see with everybody, is pulling the trigger in that first deal.
Guys, I was down in Carolina yesterday, and I felt blessed. I was sitting in the room with Matt Capital, with the Azar family. I mean, Tony and John. They're a wealth of information, and they hit upon what you guys are talking about. Tony said that there is not any B-type properties being built because it's about $100 a square foot. So for a B property, you need $100,000 to get that on, per door to get on. So there's nothing being built in the B. There's a lot of A's and there's C's. So he's like, there is nobody coming in at that level, because he says if somebody can figure that out, they're going to become super wealthy. But right now, you can't do it in space right now. And I thought that was impressive. For what you guys are talking about. He hit right exactly what you guys are talking about right there.
Well, the land's so expensive anywhere, so it's hard to do it. Some of the parks we looked at, the multifamily guys are all over us. Hey, let's why don't you clean out the park and put multifamily in there? But they're talking like $130,000 a unit in Raleigh, just as a bare minimum. It's like, dude, what are your rents going to be?
We getting $1,600 a month or what?
Yeah, it just doesn't work. And that's where I think in multifamily, the strategy is definitely to find those C plus and make them a B minus or a B all day long. It may be a little bit uglier, maybe a little bit more work, but that's where you're going to create the long-term
We're seeing
wealth.
A transition in my mind to some of the folks that may have been 20 years ago in a mobile home park, transitioning into the more suburban type C plus apartments. I think there's a little shift going on there. Not positive, but it's just kind of like something I possibly see right now.
Yeah, I think there's still that stigma of the trailer park.
Yeah.
And that's what you really got to fight. So, when we get in, we call it the playbook. We get in, we pave the roads, we put in the playground, kick out all the bad guys, tear down all the old homes, put in the new homes. There's pressure on mobile home park people just because of that stigma that you have to make those parks nice.
Yeah.
And in order for people to want to stay, sure, you have the affordability factor, but you still got to make them nice because
you don't want the neighbors coming, the people in the community come with pitchforks and protest and trying to drive you out like the witch, right? So.
Believe me, I'm buying this park in Raleigh. It's only a 70 space park, but right on both sides are brand new subdivisions, and they hate the park, So I'm going to try to put some stuff around it to keep it going, but somebody will buy the land. It's want to clear it out.
Leland cypress trees, just block it in, baby.
Exactly.
That's all the mom and pop talk right there, baby. Yeah, that's it. Mike, you're genius when you talk about 2012. What's going on with the Main Street Millionaire businesses? You had mentioned rent-a-centers. You'd mentioned Dollar General stores. I even see the Paneras, the Chick-fil-A's. People want to go out to dinner, but they don't want to spend $150 a head. Panera, I mean, I have a family of 8, so I end up spending $100 anyway. But it's basically $10 a person. So, I mean, if you're going to go into business, you can go into one of these businesses and still make a lot of money. So I think people should read the book just to see the different mind shift and what's going on with businesses. And just an entrepreneur, the more people you can serve, the more money you're going to make. And these businesses that you list really target the masses. When you say 48% of the people in this country, I think they were basically poverty level, making like $15 an hour. I mean, the statistics were staggering. I mean, I wrote a book review on it. I want you guys to go on Jake and Gino and read the book review. You'll read it. You'll be like, wow, these things are really mind-boggling. They'll open your mind and maybe they'll make you shift and say, we're going to hammer college now, but say, maybe I don't need to go and spend $300,000 to go to college. Maybe I can go to a 2-year junior college and, finish up. So you guys got to get the book, read the book and go, wow, there's definitely a shift going on. And I don't want to be caught in that shift.
And there was someone on CNN the other day that said almost 80% of the country couldn't come up with $500 in an emergency. I mean, think about that. That's like frightening. And
you said 80?
Almost 80, just under 80% would have trouble coming up with $500. And you think about that, it's that inequality level, and it's what are we going to do about it? I don't see it getting any better. I think with robotics coming and everything else, I just don't know. It's going to become an 80-20 world. You hate to say it, and you definitely want to be on the 20 side because the 80 side is a grind. And the other thing about the MSM businesses that I really like, and you guys, really in the B and C multifamily are there as well. They're very much, to a great extent, recession proof. And, really in the real estate business, we do really well, in the good times, but we do fantastic in the bad times because we're at the bottom rung of the real estate ladder. And it was amazing in 06, 07, how some of our residents would, struggle paying rent. The next thing you know, they got a $150,000 house, Well, those people all came back 2-3 years later. And when the recession hits, you always come back and pawn shops and whatever else it may be. That's where you want to – I just like those businesses because I feel protected. I feel the economy is very much boom and bust these days, where now we're riding high, the market's high again, everyone's excited. It just doesn't seem real to me.
My question is why? What's the cause of it? You know what I mean? And I feel like it's almost a lot of it's just there's a lot of debt out there right now. I don't know that there's anything to point to saying like, oh, we're riding high because of tech, or we're riding high because this manufactured or something. There's nothing. What are people pointing to right now?
That's a really great question. I don't know. I mean, obviously there's some Trump effect with him coming in the office with the stock market.
But that's not for nothing. That's hope, right?
Yeah,
you're betting on decreased regulations and hope. And so, that's you're like, people are like, okay, I want to get out in front of this. Maybe it pulls through, maybe it doesn't. History say, that type of environment would be, good for business, but we just got to wait and see though.
Jake, I have a theory on that. I think the theory is there's lack of financial intelligence. I think, like we're talking off camera before, we don't teach this stuff in school. I was amazed that a guy who goes to law school he's in school for 7 years, doesn't know anything about the financial aspect of it, and he's a broker dealer in the stock market. So, I mean, someone like me, the same thing. I went to college for 4 years. I got a BS in finance. Never talked about anything about real estate or about balancing a checkbook or about making financial investments, about the difference between personal debt and business debt. I can go on. Leverage, liquidity, and control. Those are the three things: leverage, liquidity, and control. That's what makes an asset kick ass. Talk about whole life insurance. Whole life insurance is the most fabulous thing you can do if you're creating a strategy for yourself long term. Not get in, not buy stocks, and so that I think that's the most important thing. People can't control their finances. If you can't control your finances, and you're not disciplined, you're not going to be a successful person in life. So I think that's my theory. I went through it, and I coach a lot of people, and I see how people react to money. Money is money. What is it? Money is not the cause. It's the result. So people are always targeting money. It's not really targeting money. Just target your success and, like Peter says, your massively transformative purpose, and then you'll figure it out. And you're not working for money. You're working for a passion, and the money will just come. It's just an end result.
It just allows us to trade with each other. People hate it, but it gives us the ability to trade with each other. And people are out there, and you have a job. It goes like the Adam Smith Wealth of Nations thing, right? You start that whole economy, and it just gives us an ability to trade. I agree with you, Gina. There's just like a target on money's back a lot of time, but it's just a instrument.
Jake, I'll give you an example. I'm immigrant. Parents are both Italian from Italy. I have a lot of my parents' friends who can barely read English, right? They own properties in Manhattan, hundreds and hundreds of units, and my mom can't figure it out. And I said to her, it's not the education, it's who you surround yourself and what you figure out and the willingness to take a risk. I think some of them are really, not joking, are a little ignorant or dumb to figure out that if they make a mistake, it's not the end of the world. They're willing to take that risk. To them, it's not
fearless.
A risk.
Yeah,
to them it's not a risk, but when we go to college, we learn not to make mistakes. We learn, we got to get A's and B's, and that's one of the things that I hate about education is it's so rigid, and you're not. I love when my kids get a C or a D on a test because let's figure out what you did wrong, and that's how you learn. You learn from your mistakes. You don't learn when you get something right. It basically just goes over it. So let's transition to college because I have a kid going to college, and I want some advice from you. What you tell your kids, what to do in college, where to go, how much to spend, what to look for.
Well, obviously, I'm a big believer in junior college. I think that's the way to do it. I've been fortunate that I have the money, but I told my kids, no way am I sending you to private school. It's a huge waste of money. You get no value out of that, especially here in the Southeast or in the Midwest. Maybe Harvard or something if you're going to, be in New York, maybe, I guess. But so it's only public schools, and it's really you got to have a very defined major. Before you start, you have to know what you're doing. As we were talking earlier, two of my sons are in the technology field, and they're doing really well. Job offers, things are great. That's where you want to be. My oldest daughter's in the finance business, but went to a public school and, more through connections than anything else, but she's done really well with it, and doing with mobile home parks. But I just think that's another huge bubble that's going to blow up. You've seen a lot of online stuff coming. My youngest son we adopted from Guatemala, and he's 12 now. I'll be shocked if he goes to college. He's very computer oriented, like a lot of the younger kids are. And these coding academies they have in Raleigh and Charlotte now, $10,000 for the academy, 6-month program, really teaches you how to code, which is the future, in my opinion. I know nothing about it, but I can sort of talk about it.
What is that like? Is like a key in a lock or something? What is coding?
It's basically everything that goes behind every technology. I'm the same.
I don't
way.
really know, but I'm just being a smartass, man.
Oh, totally. There was an article in Business Week about 6 months ago. The whole magazine was devoted to coding. It said either you know coding or you're not going to have a chance. And I read the first line. I had no idea what it said. I'm like, damn, this is going to be difficult.
Steve Jobs said it changed his life. It's like speaking another language. He said everyone's got to learn how to do it. And I'm like, man, I don't even know if I could.
It's Greek though, dude. If you don't have the math or science background like I don't, I can't even. I have no idea. But what I do say, these coding academies, they have a 99% placement rate. The kids are coming out at 18, 19 years old, making 60 to 70 grand, and they got a skill. And that's my biggest thing against college is they don't teach you a skill. You know nothing about the real world. You can't get a general business degree anymore. That does nothing for you. You have to be very specific, very goal-oriented early on, and you're better off working for a year or two and really finding out what the real world's about, and then going back, I think. I'm on the board at Wake Tech Foundation. Wake Tech's the big community college here, and I love what they're doing. I just think, there's still that stigma. I'm going to community college or whatever. I'm not, partying at one of the big state schools or whatever. But it's the way to go. It's super cheaper. It's the same class for like 25% of the money. And, it's 2 years. You get all your basics out of the way, and then you go do your major at one of the bigger schools.
I haven't told people this, but I think kids who are young, I would really consider and tell them to go into coaching like I do. I went to IPEC, so I went to coaching school. It's personal development. So when you're younger, you have no limiting beliefs. Like Jake and I always talk about these limiting beliefs. When you're 20 years old and you can train your mind into power of positive thinking and surrounding yourself and learning how to coach and talk about empowering questions and setting goals, that's nothing you learn in college. And that's all it is, because we all have head trash. So when you're younger, you tend to have a lot less head trash. So if you could really jump into that field, it cost me 10 grand I went for a year. And that was like the most transformative thing for me. I mean, I was like, I was stuck in a job that I didn't like. And all of a sudden I go to this coaching. So I'm like, why aren't we learning this stuff when we're 19, 20 years old, when it could really have a profound effect on us? So, like you said, you don't know what you're doing at that age, but if you can take that and at least make you think about what you want to do. And I think that's the way to go also,
Well, I agree. I agree with you 100%. And I really agree with your statement that, all this trash that you're developing. I mean, school teaches you not to take risks, not to be an entrepreneur. They want you to be a sheep and follow the corporate path. And it's really difficult because when you go on your own a little bit, it's gotten obviously in Silicon Valley and stuff, it's become the end thing. But when I was growing up you got a good corporate job, you went to a good college, that was what you did. And if you were out of the norm, people thought you were an idiot, And it's funny how much pressure there was to follow the protocol. And I'm glad to see that there's places like that you can do different things. And it's, look at me. I went to law school. I mean, you talk undergrad was worthless. Law school was worthless. I mean, it's theoretical garbage for 3 years. It taught you nothing, So, and all of a sudden I'm 25, and I've wasted, I think, 5 years of really learning anything real about the world. So.
Wow, that's awesome. Can you give us your best real estate investing tip for the listener?
I think the best tip is, it's everybody talks about, and you guys do a good job at it too. It's you make money at the purchase. You really have to understand your markets. You got to buy below the market, or in the case now, it's going to be hard to buy below the market, but you got to have that upside. So you make your money at the purchase. If you make a good buy, it's going to be a forever asset. It's going to cash flow forever. It's going to do the right thing. So I would really, it's that fine line between pulling the trigger. I always, I'm a little bit of, pulling trigger too quick, like it was in my first multifamily deals, and got into stuff I didn't know what I was doing. But I learned so much in a year, and you learn by doing. On the other hand, if you're a little more patient, there's a lot of knowledge out there from guys like you who are really helping that beginner investor. It's, once you have an understanding and really understand what your market is, and especially I would stay local initially. I think it's a lot easier to have your hands on stuff. Once you get bigger, you can go anywhere in the country. But, you're going to make your money when you make the right purchase and buy it at the right price.
So based on what you just said, I think a good way to put it into perspective is be very aggressive on taking action. Put in offers, analyze deals, jump in when it comes to taking action. Be patient on buying right. Don't overpay. Yep. Get in the game, network, analyze, put in offers, but be patient when it comes to making the acquisition, though, because that's where you gotta really hit it out of the park. The rest of it, listen, go out there and get experience.
Yeah, I totally agree with you, and especially making offers. I mean, you got to do your research. You come up with your price, and I've lost out on way more deals than I've won.
We lose out on a deal every week, I feel like now.
Yeah.
No, I mean, we just did. We just lost that over $300,000, and I just didn't feel it was like $300,000. Not that it's a small amount of money, but I was not comfortable going up that $300,000 to get it done, and we just had to say sorry.
Yeah, and this is the time in the cycle that you really got to be careful.
Yeah,
because the last thing you want to do as a beginning investor is make a bad mistake in your first deal, because it's going to sour you.
You're making me feel good about losing for the first time in my life. This is good coaching, Mike.
Jake, get lost, Jake.
You probably won in the long run, though, by not making that decision.
That's what I'm hoping here. So, what's your best habit for success? You've been in a few different real estate businesses now. You've been a really successful guy. What is that daily habit that separates you from the guys that are not MSMs?
I think the one thing I've done my whole life, and it was just sort of born with it, is I'm a voracious reader. I read everything. It's whether it's new books coming out, I read a couple papers every day. Obviously, it's easier to do everything online. I follow Kiyosaki. I follow a lot of the guys. Tony Robbins, I'm a big fan of. I just think you got to get as much information, and positive thinking. I'm huge on that. You got to have that outlook. But the more information you can look at, you feel like you can make a better informed decision. And, for whatever reason, I just love knowledge. Now, sometimes it gets to be too much, and I think Peter Diamandis had a great thing and it sort of really helped me, is on your feeds within Google and whatever, really narrow the search of what you want to get shown, real estate stuff for me, or a little bit in finance, and get rid of the rest of the garbage. I think everybody got consumed with this election, and it has no bearing on anybody. Realistically, I mean, there's going to be certain changes here and there, but the bottom line is you just got to adjust your philosophy to make more money, no matter who's the president. You'll figure it out. There's always going to be, from a macro standpoint, a demand for affordable housing. And that's, the more I read and the more I understand it, just, more committees I go on to locally, it's everybody talks about affordable housing, but they do nothing about it.
Yep.
And so it's great for the investors, because long term, it's going to be the one asset class that there's never the demand is going to be way more than the supply.
I was reading something on LinkedIn the other day, and I don't remember exactly what they called it. They might have called it the 5-hour rule, but they were talking how Oprah, Bill Gates, all these super successful people basically dedicate at least an hour to reading per day. So they're looking at, I think it just, got the 5-hour rule, but that sounds like you're doing the same thing.
It's the Ben Franklin thing, bro. You got to spend an hour a day on yourself. So, and it seems like a lot, but break it up. Do 30 minutes in the morning and 30 minutes in the evening. And that 30 minutes.
Plug in Audible. That's why you do it while you're working out, man. No, you do. You plug in and listen to Audible while you're working out. You're killing two birds with one stone. All right, life hack. That's free.
So much easier now.
Gino, that's free.
With the that was a good plug, actually. But it's, like you said, though, it's so much easier now than it used to be, because you got so much information at your fingertips, doing whatever you want to do, no matter where you are. So it's great. But it's just, there's a lot of information, and, you just got to sort of filter through what you want to look. But it's, I just think the opportunity, I'm always an optimistic guy. I think you got to be careful right now, because you don't want to overpay for stuff. But the marketplace and what both of us are doing, just in a little bit different way, is going to be huge going forward. Where are people going to work? Where are the jobs? There's going to be tons of service workers, and my client is the $8 to $14 an hour employee, and it's at least half America now, and I think it's going to 75-80% of America, which is bad for America, but good for our business, unfortunately. So.
What business book do you recommend to the listeners?
Well, I'm obviously Rich Dad Poor Dad. I'm huge on that. I just, that changed my whole thinking, because I just didn't know anything about real estate. So I'm big on that. I'm also a big positive thinking guy. So Napoleon Hill and Tony Robbins and any of those, you just can never get enough of that stuff, I don't think. And then I think the best thing going to podcasts like what you guys are doing, you go to iTunes and get so much information. And like you said, you can be driving around in the car, you can be working out, whatever. It's just a lot of good information, I think, that's online now, instead of, a lot of the young kids, they just don't read books. They just don't read anything. They read their phone. That's about it, So they get all their stuff. But I like the classics. For me, the classics have always, everything
since Think and Grow Rich to me is a spinoff. So
it really is. I love The Secret. The Secret's a great book. But it's just an updated version of Think and Grow Rich is all it is. Yep. And it sold tons of copies because of the way they market it. And Tony Robbins, he's got a great thing on Netflix now, behind the scenes documentary. He's an amazing guy, but he's just spun out other people's ideas, and he's a great marketer.
Well, and the same thing with the chicken soup guy. It's like he took the secret, then did his own secret, and everyone's got a secret, and this is our secret. Yeah. So let's do a secret book.
Got to change the podcast name. It's all about The Secret.
Do you have a deal that you could share with the listeners that would be helpful? A really good deal that kind of demonstrates, some of the qualities that it took to be successful, or something that would be beneficial to someone's investing career.
Here's, there's obviously, I can give you, the examples like I did before about, you're buying at the right time and stuff like that. But really, I think the deals that I've done the best at are the ones where I sort of stuck to it. Like that deal I was telling about Raleigh, I was bidding against another group in Detroit, and we kept going back and forth, and went from like $4.5 million to 5.2. And I'm like, this is ridiculous. We got to do final offers. And these guys in Detroit are notorious for retrading.
Retraders.
Yeah. They're great at getting the mom and pops down to the last week, and then cutting the price by $500,000 or $1 million, which I have a real problem with.
I hate that.
I hate it, man. I'm with you.
It's unfortunate, but that's their business practice. But the cool thing about this is I told the mom and pop that I was buying from, like, we did the final offers. I got up to like 5.3. They went up to 5.9. And I'm like, there's no way. The numbers don't work. They're going to retrade you. And what was great about it is I forgot about the deal, went on to the next thing, figured 60 days later, the guy calls me. He's like, they retraded $1 million in the last week. Went from 5.9 to 4.9. And they said, we want to honor you. Are you still want to do your price? I'm like, absolutely, and came back at it. So, you still hope there's some good people in the world that you can do stuff like that. But it's about, you got to set your price and you can't go over your price. You got to move on to the next deal. There's always going to be another deal. At times like this, it gets frustrating a little bit because you feel like you lose out on more deals than you get. But the ones that you get are absolute home runs. So you just got to keep moving forward.
I can't echo what you're saying enough because we run into this all the time. These guys come in higher, and I'm saying, look, they're going to retrade. We just closed on one in March. Same exact thing. They came in, retraded, came back to us, we closed. And we tell these guys on the front end, we are giving you this offer because we can close at this price and make money. The numbers are what they are. These people need to make money too. So if they're coming in like this, they're going to retrade you at some point. They're going to go do an inspection and say, oh, we just found this, that, and the other thing. So, anyways, is what it is. One
other thing we should talk about too that I would recommend too is my buddy Craig Haskell of Value Hounds got this really good money raising program. I wish I would have taken that initially. I would have raised a bunch more money, I think, than I primarily used my own money. I had it and I've been able to multiply it over a period of years. But I think, OPM, other people's money, and doing it right, you always want to have your own skin in the game. But I would highly recommend people take courses like that, really understand the legal aspects of it. I think it propels your career a lot quicker. And, if you can offer people anywhere from 8 to 10% right now, you can get gobs of money. So everybody's looking for the return. Everybody's leery of the stock market. And I think if you do some of those courses, I don't know how you guys do it, whether you do investors, but I think it's a very key part of the business that you don't really think about because everyone wants to analyze the deal and this and that, but it's really about getting the money to get the deal done.
Well, what's funny? I try to start people off. The first thing beginning investors to get to the first 20 unit, I really try to have them focus on what their end game is, what they're trying to do. But then I try to tell them to focus on the market. And then I try to tell them to focus on how to get into the business and how to analyze a deal because the money will come. If you can convey to an investor what you're doing, what your plan is, and what your model is, the money will come. But everyone gets blocked off about the money. And Jake and I did too. We ended up finding a fantastic partner. We ended up growing the business and the same thing. But I think people really have to learn the business from the ground up, get in the trenches, manage your first couple deals, see what's going on, build yourself up, and then that money will come. If you can buy a 100-unit deal and you can give them 8%, 12%, it's hard for them to know that, but the money will come. So just really learn what you're doing in the business, and then everything will take care of itself.
That's a great point. I totally echo that thought. I mean, especially if you can convey and sell a business plan, a short business plan to an investor. It's the time is now for yield. I mean, everyone's still chasing yield, and the lower, obviously, the better for you. But we typically do 10%, and I bat people away now. I mean, it's just you really got to be selective who you do business with. But when you're younger and you're newer in the business, getting access to a good partner may not be your end partner. Maybe you're just your starting partner and cash them out after a couple of years. But it does propel your career and allow you to buy more deals.
I like that.
Where can people get the book?
Amazon. The book's available at Amazon. I'm just redoing my MSM website, so that'll be done. It's going to be MikeConlon.com, so that should be done in the next month or so. And then if you want more information,
how much do you have to pay for
that one? The website?
Yeah.
It typically runs anywhere from $4,000 to $7,000.
No. To get the domain name, because when I looked you up on Skype, there was like 3,000 Mike Conlons.
I don't know where all these Irish boys came over back and way back when. So it's funny. I run into I'll be Googling. There's like a professor at the University of Florida that's a Mike Conlon too. And I don't know. Somehow I got it. I got it 10 years ago or something.
That's how you got it.
Oh.
Yeah. So I just kept it for a long time.
Good for you.
Yeah. But Yeah, so the company website is agcmhc.com, Affordable Communities Group. ACGMHC.com. Said that wrong. Where you can learn, about more about what we do and the parks that we have and stuff like that. And the other thing I would say, and I've talked about in the book, and I really think the one thing that distinguishes the really good investors from, I think, the average or the poor investors is if you reinvest in your property. The people that you guys and that I'm dealing with have been kicked to the curb so many times in their life. If you just do a little bit extra for them, do a Christmas party, or just clean up the road, make sure the roads are good, or make sure your property is super clean and safe. And it's amazing what loyalty you can get from those people. So I would reinvest in your property. It's well worth it in the long run, and you'll get your money back.
I agree with that.
It. Guys, this has been real, and if you guys found value in today's show, please go on iTunes, give us a like, give us a subscribe. Anything else, Mike, before we sign off?
No, I really appreciate you guys having me, and I really wish you guys continued success and all your listeners.
Same.
Thanks, Mike. Had a great time.
Okay. Take care, guys.
Bye, guys.